Hey, what's going on everyone? It's Griffin here, and as always, I hope you're having a great day. Now, in today's video, we're going to be speaking about core ETFs and the importance of holding core exchange traded funds in your stock market portfolio, which is a concept that I've been speaking about for now around 3 years, basically ever since I started making content speaking about stock market investing on my channel. In this era of expected quick returns from especially newer retail investors that may have only got into the investing game over the past year or so, with phenomenons like GameStop, Dogecoin pumping to the moon, etc. Well, of course, it's fun to stay up to date with these relevant and more trendier meme style of investment topics, but ultimately what I try to speak about mostly on this channel is the importance of proper portfolio construction and asset allocation based on your profile and needs as an investor, because ultimately this is what's going to ensure longer term success in the growth of our portfolios. So yeah, with the amount of new viewers to my channel over the past couple of months, I really thought it was important to make today's video and remind everyone of the importance and critical aspect of including core exchange traded funds to a well-rounded portfolio. At the end of the day, while it can potentially be more fun to actively trade stocks and try to create a higher return on your invested capital with shorter term swing plays or more speculative stocks, well, it's really important that you remember to only allocate a much smaller portion of your portfolio, maybe say 5 to maximum 10% of your portfolio's total value, to these smaller cap stocks and more speculative plays. And then from there, also have a more set asset allocation for your equity positions and your fixed income positions. From there, you then also want to have a healthy portion of what I call core ETFs, core exchange traded funds, because these are the types of passive investments in your portfolio that are going to create that more steady and baseline return over time. And what's more is that these passively managed exchange traded funds that we'll be speaking about today tend to have very low management expense ratios, often rock bottom, as we'll be speaking about soon. So you get that instant diversification with an exchange traded fund. You also get a very low management expense ratio, and you also get a more steady and baseline return for those positions rather than the more actively traded positions in your portfolio. And to be honest, I usually even recommend for most retail investors who aren't looking to actively be involved in the management of their portfolio on a weekly or even monthly basis to hold maybe even up to 50% or more of their total portfolio's weight in these passively managed broad core exchange traded funds. Because just looking at the data here over the past 10 years or so, and even longer potentially, the average returns of these broader exchange traded funds are typically 10% or even more. That is very hard to replicate, especially for retail investors that are actively buying and selling stocks, day trading, swing trading, trying to beat the market with little to no expertise. So if you've been following my channel for a while now, then this is definitely not news to you. I've been speaking about portfolio construction with core ETFs for quite some time now. Here are a couple examples of videos I've made over the past year speaking about this topic, but hopefully this is something that you're also implementing in your own portfolio, because truthfully, the returns are there, especially for the level of passivity that these funds bring to your portfolio. All right, so I'm going to stop rambling about the importance of core ETFs here. Truthfully, I could speak about it for quite a bit longer because I really believe in this portfolio construction strategy, but we're going to be speaking about 2 core ETFs in particular that I bring up quite regularly on the channel to see with concrete data why I believe that this is a really fundamental strategy for most retail investors. All right, so starting with the first index fund that absolutely everyone needs to have some exposure to in their portfolios, we have the Trustee Sp 500. And this is an index that you can easily gain exposure to with the VFV ETF offered by Vanguard up here in Canada, or if you're located down in the US or want to hold an S&P 500 ETF in US dollars, some good options include SPY and VOO, which is also offered by Vanguard. Now, the S&P 500 is one of the most widely recognized indexes in the entire world, and most investors are familiar with it. Essentially, it tracks the 500 largest American companies. This includes staple companies like Amazon, Microsoft, Apple, and now even Tesla. But the beauty with an index like this is that it constantly changes and gets updated to contain a weighted balance of these companies. And what this ends up producing over time are relatively steady and consistent returns for investors. Even though not the flashiest investment by any means, consistently and passively earning around 10% on your money for doing basically nothing is fantastic. And actually, over the past 10 years, take a look at the average returns that we've been experiencing with the S&P 500. This is hard for many fund managers to even replicate, let alone a passive index fund. So while you're out actively generating more income through the front door that you can use to invest with further, well, in the shadows, an investment in an S&P 500 index is working for you around the clock. So yeah, I try to allocate around 15% of my portfolio at any given time to an S&P 500 index, or an ETF that is that tracks the S&P 500, because this is just such a staple investment for that consistent growth over time, and it's just such an easy way to start compounding the growth of your returns over time. And so as an example here of one of my own S&P 500 index holdings through the VFV ETF, which once again is a Canadian S&P 500 exchange traded fund offered up here in Canada by Vanguard Investments. Well, here's a clear example in one of my investment portfolios. So you can see here the average price was $67.32, and this was, I think, less than 2 years ago, so really not that long in the big picture. And in terms of this one portfolio, it does represent a larger portion, around 17%, but the total return has been 36.5%. I mean, that is pretty awesome for literally doing absolutely nothing other than just buying and holding that position. And again, like, is this the best return I've ever created on one of my investments? Of course not, but for the amount of passivity that a holding like VFV or any S&P 500 index for that matter really brings to your portfolio, that is a great return. You can't really get better than that. Or wait, can you? Actually, to answer that question, we're gonna have to speak about the second core ETF that I like to speak about, and that is a Nasdaq 100 ETF. The Nasdaq 100 index, this is also an index that I consider to be a core holding in most retail investors' portfolios, especially if you're more focused on a higher level of growth. And you can gain access to this index very simply through, once again, an exchange traded fund. This is pretty much the exact same concept as the S&P 500 index, but instead of the 500 largest American companies, we're looking here at only the top 100 companies that trade exclusively on the Nasdaq exchange. And just by the nature of this exchange, the holdings are always a lot more concentrated with information technology stocks. So some of the largest holdings include Apple, Microsoft, Amazon, Tesla, Facebook, Google, Nvidia. You get the picture. These are some of the largest and most influential companies in the entire world. Now, some could argue that if you're already holding an S&P 500 ETF, well, you're gaining exposure to those typically top main companies that trade on the Nasdaq exchange. And yeah, that's definitely true. There is some truth to that. But what I would say to this is that on a relative basis, each holding is going to be significantly smaller because, well, the S&P 500 is a much more diverse exchange traded fund that has essentially 5 times the amount of stocks that the Nasdaq 100 holds. And so the S&P 500 is also a lot more spread out in multiple different industries than the Nasdaq 100. So if you have a portfolio that's more tailored towards growth, the Nasdaq 100 is typically also going to get you there a little bit quicker. We're going to be looking at some returns right now. So yeah, taking a look at it right here, I mean, the average returns of the S&P 500 are fantastic for the level of passivity and exposure you're getting, but historically are much lower than that of the Nasdaq 100. So yeah, if we do take a look at the average returns of the Nasdaq 100 over the past 10 years with the QQQ ETF right here, which is offered by Invesco, well, you know, it's quite evident where average returns over the past 10 years, 20.18%. I mean, that is just crazy if you think of it. Yes, over that period of time, we have pretty much been in one of the largest or the largest bull market, or longest, I should say, bull market in history. But even still, if we take a longer approach here, a longer look at 20 years, well, we're still seeing very nice, consistent and passive returns for an investor in a Nasdaq 100 ETF. Now, I will say this, 20% annually over the past 10 years, definitely don't count on this moving forward. This has been one of the most lucrative periods in history for this index. But the point still being that a $10,000 investment made 10 years ago into this fund with only $5,000 added every single year to it at that average 20% yearly, I mean, you're now looking at an amount that's totaling just under $200,000. Name me an easier investment to make with that level of annual return. It's difficult to do. Now again, is this past performance indicative of future performance? Ultimately, no one really knows, but what we do know from a historic standpoint is that if you consistently buy into these core ETFs, these core funds, buying the dips and dollar cost averaging as you go, well, you're pretty much just putting a higher percentage of chances on your side for the future success of the growth of your portfolio. So really, if you think of it here, just through an S&P 500 and a Nasdaq 100 ETF, if your portfolio was exclusively comprised of those two exchange traded funds, and over the past 2 years only, you consistently bought into these two ETFs and dollar cost averaged your way into them on the dips each month, well, you would probably be looking at a position that's well over 40% appreciated during that short period of time. That is fantastic for, again, that level of passivity of these two exchange traded funds. And that right there is what I mean by consistent baseline returns for your portfolio. While you're out maybe doing some more research on individual positions that you believe you have a strong thesis on for further growth that can potentially beat the market, well, in the shadows of your portfolio, those core ETFs are there working for you, creating a steady baseline return. All right, so that quickly covers the S&P 500 and the Nasdaq 100 indexes, which I consider to be two of my go-to core ETFs for the construction of my own portfolio. But there are definitely other indexes that one could consider to be core holdings. Other popular examples of ETFs that could be considered to be core holdings include, for example, a total US market ETF, a Canadian TSX 60 ETF, small cap stock ETFs, and even international market ETFs. Depending on the type of investor, these could also be considered core holdings. There are, however, some main differences to consider between what I would consider to be a core ETF versus, say, a secondary position or exchange traded fund in a portfolio. First of all, it needs to have enough diversified exposure to multiple different companies. At a minimum, typically 100 with, say, the Nasdaq 100. A TSX 60 ETF is obviously only going to hold 60 positions in the Canadian market, but typically diversified exposure is something that you want to look for with a core holding. The second main element that I usually look for is that it has to be a passively tracked index that's at a minimum, say, 10 years old, and the longer the better, so that we can have longer operational and performance history that we can base ourselves on for that consistent baseline portfolio return. Speaking of returns, for a core ETF, I also like it to have a consistency in earnings exceeding 7% annually at a minimum. Now, following that, the ETF has to have a low management expense ratio. In Canada, the MERs are typically higher than in the United States. In the US, many passively managed ETFs can have rock bottom MERs in the 0.03% range. In Canada, typically this is a bit lower, but anything under 0.2% is definitely preferable. Even still though, a slightly higher MER with, say, HXQ is nothing compared to the fees that you'll have and experience with, say, a mutual fund. And then finally, I also like to look for core ETFs that have a medium to higher amount of liquidity, because this just allows you to more easily buy and sell the positions over time when you're dollar cost averaging or trimming off your positions. So that's pretty much it for today's video. I just wanted to quickly go over once again core exchange traded funds and proper portfolio asset allocation. If you want to learn more about this, I would highly recommend that you check out some of my other videos on the channel where we've gone over portfolio deconstruction in terms of different weights to asset classes. But yeah, just with the amount of hype towards certain stocks and industries right now, I thought it was really important to really just go back to the basics and learn and speak about core ETF holdings for those consistent baseline returns. If you enjoyed the video, make sure to smash the like button. It really helps the channel out. And also, if you want to learn more about stock market investing, real estate investing, and other topics of that nature, make sure to subscribe to the channel and hit the bell button to be notified of my my upcoming content. Now, also, if you're newer to investing, I would highly recommend that you check out the links down in the description to resources that I use and recommend, like some stock brokerages. If you use the links down in the description, you will get some free money for signing up. So on that note, thanks a lot for watching today's video, and I will see you in the next one.